KQQQ's 17% distribution rate gets investors' attention, but is it worth the risks? Our subscriber, Gary Hicks, asked me to review KQQQ, the Curve Technology Titan Select ETF. KQQ has had a good run so far, annualizing 20% returns, total returns, since inception, outperforming the Nasdaq 100. I'm going to walk through KQQQ's concentration risk, option results, and performance, and then we'll compare it to other Nasdaq ETFs like QQQM and QYLD. If you have a fund or financial product you'd like me to review, leave it in the comments down below. I reviewed other covered call funds like CHPY, QQQI, and GPIX on this channel. Check those out too. KQQQ launched in July 2024, which is less than 2 years of operating history. The distribution rate is 17%, and the fund holdings show about $100 million in net assets. The objective of the fund is maximizing total returns while keeping consistent with prudent investment management. The fund focuses on large cap technology companies. It buys equities directly, uses options, and invests in other ETFs. The website notes that the portfolio is weighted based on, quote, momentum signals, but doesn't specify beyond that. Here's the first major consideration for investors. KQQQ is significantly more concentrated than the typical Nasdaq 100 ETF. Based on the fund holding data, nearly 25% of the fund is in just two stocks, Alphabet and Amazon. For comparison, if you look at a plain vanilla Nasdaq 100 ETF like QQQM, the top two holdings are about 17% of the fund. Plus, there's 100 names in total versus just 19 equities, excluding option exposure for KQQQ. In QYLD, the top two holdings are about 16% of NAV, plus you get the options trading. Now, KQQQ's website acknowledges this. The website states that the Nasdaq Top 15 is intended to provide a better suited performance benchmark according to the design of this strategy, which focuses on the largest 15 to 20 technology companies, majority listed on the Nasdaq. Fair enough. However, the performance data on the website compares KQQQ to the Nasdaq 100 total return, not the quote top 15, so there seems to be a little bit of a disconnect. Anyway, why does this matter? Because if you're taking on additional risk, like concentration risk, you should expect compensation in the form of better returns. If you aren't getting better returns, why take the additional risk? We're going to look at returns a little bit later. For now, let's look at what the option data shows. KQQQ's option writing strategy appears to be, for a fund the size of KQQQ, this isn't a lot of money. But it also means that option writing, so far, has not been a significant contributor to distribution income. Keep in mind, this may not represent the entire option trading profile due to the way the option accounting works. When option trades are closed versus when they're exercised may change how gains and losses are allocated in the financial statements. Basically, if the trade is closed, then the option gains or losses get recognized at that time. If the options are exercised, however, premiums received or paid get kind of rolled into the stock. The gains or losses of which likely then go through the investment line item in the financial statements. Long story short, the financial statements may not show the entire results of the option trading strategy in isolation. In aggregate, all results ultimately flow through the financial statements. That's a bit frustrating for analysis because we can't cleanly separate how well did the stock picking do from how well did the option strategy work. And with the fund that's applying more active management than passive management, investors would ideally be able to see the distinction. From what we can see, writing option does not appear to be overly inspiring, particularly as it relates to generating income for distributions. Which brings us to our final point, which is performance. Quick ask, if you're getting value from this breakdown, hit the like and subscribe button. It helps show this to investors who need to see it and helps me know that I'm on the right track. Okay, performance. This table compares KQQQ to QQQM, QYLD, and the Nasdaq 100 total return data on the KQQ website. KQQQ has outperformed the Nasdaq 100 by about 1% since inception. Over the last year, it underperformed by about 4.5%. When compared to QQQM and QYLD, KQQQ has underperformed QQQM by about 4% and outperformed QYLD by about 7% over the last year. Data isn't available to compare QQQM and QYLD to KQQQ since KQQQ's inception. However, the table shows the 3-year performance for those two funds. It's important to remember that KQQQ uses options to create synthetic positions rather than just a simple cover call strategy like QYLD. The difference in strategy could explain some of the performance gaps to QYLD. KQQ has a higher fee structure at almost 1% compared to funds like QQQM, which has a 0.15% fee structure, and QYLD, which has a 0.6% in fees. I think the contrast to QQQM is the most stark. With KQQQ, you're getting less diversification, paying more in fees, and the performance edge, so far, has been inconsistent. Beating a passive market index consistently is difficult. Most active managed funds fail to do so over long periods of time. KQQQ might succeed, but with less than 2 years of data, it feels like investors are being forced into making a more speculative choice regarding the long-term effectiveness of KQQ strategy until it's maybe more fully proven out. Now onto distributions. Distribution rate currently is a little over 17%. From the financial statements, the fund distributed more than it took in from all income sources for the periods ending May 2025 and November 2024 combined. Is the current distribution rate sustainable? It's hard to say. The fund is still relatively new. Ultimately, any fund that distributes more than earns an income will shrink or will be forced to cut its distribution rate. So in conclusion, KQQQ doesn't seem to position itself as a core holding. Yes, you're getting a high distribution rate, but the trade-offs appear significant. Less diversification, higher fees, unclear option strategy performance. Investing always involves trade-offs. When you compare KQQ to other funds, it's a struggle to see if investors are receiving additional extra compensation for the additional risk that they take on. Can a fund like KQQQ fit into an overall investment strategy? I'm sure it can, depending on the individual investor and goals and risk appetite. But it's up to you to determine how that looks. Investors need to think beyond the simple distribution rate. If you found this video useful, drop a like and subscribe. And if you have a fund or financial product you want to review, leave it below down in the comments. Hi, I'm Charles. I don't like most investing or finance content online. It tends to try to sell you something. You don't need to buy anything from me. This content is for entertainment purposes. Seek professional advice for your situation. I want to make financial freedom accessible to the average person. Profit is desirable, ownership is freedom. Good luck and goodbye.